All right, one other option that people can use to incentivize people to, perform well for a company and help contribute to the overall value of the enterprise is just giving them a straight up capital interest, like a regular unit grant, or give them a membership interest in the LLC. Now, one of the main things that holds people back from doing that is that, number one, with membership interest in an LLC come certain kinds of rights, oftentimes voting rights, information rights, and it doesn't necessarily tie people toward any specific goal of the LLC as opposed to overall value of the enterprise, which may or may not work for that person. Now, you can use a unit grant in combination with something like a yearly bonus or an annual bonus or a bonus at exit to kind of focus in on things. So these can be a good complement to that. But the other reason that really kind of prevents some people from issuing membership interest once the company has achieved a valuable state is that when you give someone that property, membership interest in LLC is like property, just like a car or a boat or a house or cash, really. The IRS treats it as if you've given them compensation. So it's just like paying them a large bonus. The IRS will say that person, if they didn't pay for that unit or that membership interest, has income equal to the value of it less what they paid. In this case, let's say it's zero and it's worth $100,000. They've had $100,000 worth of income in the tax year that grant is made. So that means the employee has to start paying a tax, whatever their tax rate is, of that $100,000, which often case makes this an impossible feature to do. However, if you're just starting out, it might be a little bit easier. If you don't think that this is a viable scenario for you, there are other options that we talk about in other videos, and you can find those on our channel under the equity incentives for LLCs topic. But one thing that we have seen people do in some cases, and it depends on someone's personal financial situation, but maybe the company does issue that grant to that person, but the person signs a promissory note to have to pay for those. Now, the promissory note has to be a real debt. It can't be a sham transaction, otherwise the IRS won't respect it. So they would have to pay that amount either over time or at some balloon maturity date, and that could have a benefit to that person from canceling out some income tax or something, but you have to talk to a tax advisor in those situations, and they become, more complex than you might otherwise assume. If you do equity grants and you want to specifically tailor the rights of the people who are getting them with respect to voting and make them non-voting, or only give them certain voting rights or certain information rights, then you really need to talk to a practitioner and make sure that they can guide you with the right things to set up to prevent problems for you or the person that's receiving them. Another factor is just like profits interest, which we explain in other videos. If you give someone a capital interest, they 100% become a K1 partner in an LLC that's taxed as a partnership, meaning that they're self-employed. Any wages that you pay them are now in the form of guaranteed payments, and their tax filing picture gets complicated versus them just filing as a W-2 employee. So those are the things to think about, some of the things to think about. If you have any other questions, hit us up in the comments, call us below. Remember, we're not providing legal advice in any of those comments, but if you're looking for information, best thing to do is get in touch with us and link and subscribe to our content so you can learn more in the future. Thanks. All right, bye.